Exchange traded fund, mutual fund, index fund. You've heard of these terms being tossed around before. Now you're probably wondering, what should I invest in? And what the hell are these things anyway? Am I supposed to be trusting my money in these products? Welcome to my channel. My name is Michelle Hung from The Sassy Investor, your go-to channel for everything to do with personal finances, investing, and money mindset. Be sure to hit the subscribe button below for more weekly videos like this. In this video, I'm going to explain to you what exchange-traded funds are, what mutual funds are, what index funds are, and what the main differences are between all of these things, so you can be the judge of what you should be investing in. And as usual, I have a sassy bonus tip for you, so be sure to stick around for that. First off, what is a fund? A fund is simply just a pool of money, and it's used for a specific purpose. For example, you may have an emergency fund, and the purpose of that is for you to have cash in case there is an emergency. So that fund is probably just sitting in cash, hopefully in a high interest savings account. When we talk about funds like an exchange traded fund, ETF for short, or a mutual fund or an index fund, these are just pools of money that's invested in products like stocks, bonds, currency, whatever assets are out there. And the purpose of that is to generate a return, and a much higher return than a savings account. Now, the differences between a mutual fund, index fund, and an ETF is how they're managed and not so much what it's invested in. So let's compare a mutual fund to an ETF. An exchange traded fund is just that. It is a fund that is traded on an exchange like a stock. That means you and I, anyone in this world, are free to buy and sell ETFs at any point during the trading day, much like stocks. You can get in and out of ETFs whenever you want. When it comes to investing in a mutual fund, it generally comes with certain restrictions, like a required minimum investment upfront or ongoing monthly investment. For example, there are mutual funds out there that require a minimum initial deposit of $100 with ongoing subsequent investments of $25 per month. And if you decide to take your money early out of these mutual funds, you could be subject to something called an early redemption fee. With exchange traded funds, because they're traded like a stock, you will not get penalized for selling your ETF. Also, when you buy or sell your mutual fund, that is usually processed at the end of the day. So once a day, unlike ETFs, which are processed throughout the day. If you want to buy a mutual fund, you generally have to go to a specific bank, and that bank will offer you their own in-house mutual fund. For example, BMO, Scotia, TD, RBC, each of these banks have their own in-house mutual funds that they offer to their customers. But before you start heading to the bank and inquiring about mutual funds, hear me out on this. Canadians pay one of the highest mutual fund fees in the world, and that's around 2.3% per year. Now, that doesn't sound like a lot of money, but actually it adds up to so much over the long run. Mutual funds are very expensive compared to ETFs. Imagine you had a $100,000 investment portfolio and you're being charged 2% per year. That's $2,000 each year. And imagine your portfolio goes to $500,000. That ends up being $10,000 per year, year after year. All of those fees added up can easily amount to a couple $100,000 by the time you retire. This is a down payment on a home. This is the cost of your child's university or college tuition. This is several cars. You get the point here. Now, to be fair, the mutual fund industry has been around much longer than the ETF industry, and mutual funds is what traditionally the banks will sell to people that are looking for ways to invest their money. Now, the ETF industry came in and said, enough is enough with these fees. ETFs offer an alternative for DIY investors, and not only are they flexible because you can buy and sell them at any point during the trading day, they also don't have these minimum investment requirements or early redemption fees. And they are also significantly cheaper. There are ETFs out there that cost 0.2% or even 0.08% per year, a fraction of the cost of the average 2.3% per year that mutual funds charge in Canada. Now, one of the reasons why mutual funds are expensive is because of how they are managed. Mutual funds are generally actively managed as opposed to index funds that are passively managed. When I say actively managed, that means the portfolio manager of the fund has full discretion as to what he or she does. He or she can do whatever they want, but that does require a lot of work. It's It's pretty labor intensive. A lot of research and time goes into investing and picking individual stocks for their portfolios, which means the portfolio manager will need analysts and assistants in managing that money. Not to mention the people that sell these mutual funds need to get paid, and the people that market these mutual funds. All these people need to get paid. A lot of mouths to feed, so it gets to be pretty expensive, and it's at the cost of the investor. When a fund is actively managed, just think of it as being labor intensive. So is there something that's less labor intensive? Something that's passively managed as opposed to actively managed? This is where index funds come in. Remember back in the day when we didn't want to do our assignment or homework, but you had to hand it in the next day? What would you do? Well, you copied off someone, and preferably some brainiac that's going to get you a good mark on it. And that's what an index fund is. It is a fund that is passively managed because it copies off something called an index. And what is an index? Well, an index is simply just a list of companies, and that list overall represents something like a country's economy or even a sector. For example, the S&P 500 index is a list of the 500 largest publicly traded companies in the US. So all these 500 companies combined, companies like Amazon, Apple, Facebook, Alphabet, Walmart, Walt Disney, all of these companies combined is a good representation. It's a good gauge of the US economy. If there's going to be a technology index, you bet there's going to be all those sexy technology companies in this index. And who decides what goes into this list? Well, the brainiacs at S&P Global, MSCI, and FTSE Russell are the ones that create these indices. That means they're the ones that do all the research and analysis, and they create these indices for fund managers to copy off of. They do all the heavy lifting. So portfolio managers that want to passively manage their fund, they have someone to copy off of. Minimal work on their part, no thinking required. They let the brainiacs decide what goes into their fund. No thinking involved means less costs. And as you do your ETF research, you will see the names S&P, FTSE, MSCI pop up a lot, because these three companies are the largest index providers in the world. Now, is there such thing as an actively managed ETF? Yes, there is. Not all ETFs are index funds. There are passively managed ETFs, which are the index funds, and then there are actively managed ETFs. For example, if you check out Horizon ETFs, ARK, and Evolve ETFs, these ETF providers have both index funds and actively managed ETFs, and their fees will vary. At the banks, you'll find that they'll have mutual funds, actively managed ETFs, and also passive index ETFs. Now, having said that mutual funds are more expensive, should we avoid them altogether? Even though 95% of actively managed mutual funds don't outperform the market index, and that's because once you consider the fees that they charge really eats into the investor's returns, it may have its merits. There are some brilliant portfolio managers out there that can outperform the market, which justify their high fees. It's not the majority, but they do exist. So for the most part, if you are starting out, try to avoid these high fees. Now to summarize, an ETF is traded like a stock, hence its name, exchange traded fund. And an ETF can either be actively managed or passively managed, and that's what index funds are. Whereas a mutual fund is generally actively managed, and when you buy or sell your mutual fund, the order is processed at the end of the day. And they usually have some form of minimum required investment up front. And here's your sassy bonus tip for you. Keep in mind, everyone is more or less invested in the same thing. For example, if a fund is invested in the US markets, what's in the US? Those giant tech companies like Amazon, Apple, Facebook. They have those massive banks like JP Morgan, Wells Fargo, Goldman Sachs. There's Walt Disney, there's Walmart. And if you're in Canada and you want to invest in a Canadian fund, what do we have? Well, we have our big six banks like TD, RBC, BMO. We have 3 telecom companies, Bell, Rogers, TELUS. We have 2 airlines, Air Canada and WestJet. We have 1 giant tech darling, Shopify, and a whole bunch of oil and gas and resource companies. So why pay more when there's a lot of funds that are invested in the same thing? Keep in mind, when it comes to the fees for mutual funds and ETFs, it is a race to the bottom. It has become a commodity. That's all for today. Hope this video has helped you. If you have any questions, please leave a comment below and I will respond. Hit the subscribe button for more weekly videos like this. I will see you later.